Hello and a warm welcome to Talking Stocks. I am Gugulethu Tsele. Also in studio with me every week, I'm joined by Peter Armitage and Sean Ashton, both from Anchor Capital. Now, these two are the experts, and every week we bring you insightful analysis into JSE-listed companies. And today we take a look at international specialist banking and asset management group Investec. It provides financial products and services to clients in the United Kingdom, South Africa and Australia. Investec was founded in Johannesburg as a small leasing and financing company in 1974 and is now listed on the JSE London Stock Exchange and is a FTSE 250 company. Gentlemen, thank you so much for joining us today. One thing's Investec, you'd think of the different silos that it has, the asset and wealth management as well as the specialist bank. It's slightly complicated for some though, Sean.
It's a fairly different mix, and I think it's one which you can't box into the typical big four bank type of business that operates in South Africa, nor is it much like the high street banks in the UK or the investment banks. It's kind of a hybrid model in the sense that you've really got three separate operating units. You've got the wealth management business, which is largely a private client asset manager. You've got Investec Asset Management, which is the institutional asset manager. And then you've got what they call specialist bank, which is everything else. And that's private banking, aircraft finance, you name it. And I think what differentiates this business from a lot of other listed banks in our space is that certainly the first two parts of the business are very capital light. So they don't employ a balance sheet to grow. And then you've obviously got the banking operation, which is where you're employing balance sheet to earn a return.
Looking at the year-to-date relative performance, though, for 2014, when you compare it to the other indexes, how has it managed to fare?
So it's done exceptionally well. I mean, we invested in this business, I think, in the low 70 rands earlier this year. I think year-to-date it's up about 30% or so. So just north of 100 rands per share. And the domestic banking index, I think, is up about 20% or so, which is somewhat less than you've seen from Investec. So it's
been the winner. It's
performed very well.
Yeah.
Does timing have anything to do with it, especially given the crisis we had back in 2008, 2009?
Absolutely. I mean, they're still making roughly the same amount at the bottom line, earnings per share, than they were doing 5 years ago. So I think much like the world economy, Investec didn't really clean up its books enough. All the US banks took the big write-offs, the earnings got slashed, and they've come back and bounced back, and their capital look reasonable. Investec, much like some of the South African banks, left a lot of stuff on their balance sheets, and they left the subpar businesses in the mix. So what you've seen now, 2008 to 2013, 14, they've done the things like sell off Australia, sell the Kensington business in the UK, the businesses that were dragging it down and reducing your returns. And we sensed when we invested in it 6 to 12 months ago that they were starting to get rid of that stuff, and you'd start the upward trajectory. I think Investec is flattered to deceive for the course of the last 4 or 5 years. It should make much more money based on its capital base than it shows in its income statement. And everybody was expecting that to kick through, but it took quite some time to get there. But we think they're now there. They've made the hard calls. They've taken the pain, possibly some pain they should have taken some time ago. But the forward trajectory looks pretty exciting.
Let's touch on that. You mentioned the streamlining and getting rid of several assets. Well, we did catch up with Stephen Kosef, the chief executive of the firm, who had more to say about some of the sales that took place with regard to some of its assets. Let's have a look.
We sold 3 businesses that the market really didn't like us to have. We sold a mortgage business in Ireland, a mortgage business in the UK, and we sold our Australian bank, which they believed was below scale. We got a good price for the Australian bank, but we would have made a loss on the sale of Ireland. And the market liked the cleanup. So that's why, NAV markets look forward. You look at NAV, which is what's happened in the past. And I don't think they're too linked.
This cleanup that he refers to, is this having a direct correlation with the return on equity for the specialist bank in particular?
Absolutely. So I think, and I think we need to differentiate between assets that they've sold and business that's still on their books, which they regard as non-continuing, in other words, the legacy book. But what you're seeing in the UK right now is a picture of overall returns of probably 11%, I think is the rough number. But inside that number, you've got the core bank making a return on equity of 17.5%, which we actually think looks quite high. But at the same time, roughly, I think it's about 300 million rands worth of capital out of a total, 300 million pounds worth of capital out of a 1.2 billion pound capital base that's actually deeply loss-making. And that's what they call their legacy book. Now that's going to run down over the next 4 years. They're not writing new business in that space. But effectively that NAV over time I think will erode. But the core parts of their business that the business that they're moving forward with in terms of good business is actually quite a profitable business.
The return on equity, I understand that's slowly on the mend.
Absolutely, and this is part of that process. So as you close the doors to writing that bad business and you get that bad business off your books, so you're not allocating more capital to it, and ultimately the good business, or the good bank, if you want to call it that, is a higher return business. So the mix of it will improve.
So that 300 million pounds gradually gets sold off, and they realise it, and then it gets invested in things that earn a 17 or 20% return as opposed to returning nothing. So the return on equity is sitting about 11% at the moment.
Yeah.
That's way too low. This bank should be doing quite a few more basis points, percentage points ahead of that.
Exactly. Well, you've touched on some of the impairments that have been taking place, but what does this mean for Investec as a stock on its valuation measures?
So I think from a valuation perspective, the market, the way we look at this business is quite simple. We say to ourselves, for the capital light part of the business, which is really wealth and investment and the asset management units, you can apply a percentage of assets under management, which is a typical valuation methodology of looking at wealth management businesses, or a PE multiple, and that's what we do for that part of the business. We then say to ourselves, what is the market then implying for the banking side of the business? And when you look at the current share price, I think the market is implying, assuming our valuation of the capital light businesses is fair, the market's implying about 1.25 times on the NAV of the bank. Now, in time to come, the return on equity that the bank will generate will justify a higher price to book multiple on that part of the business. So we think that there's probably fair value of about 115 Rand a share if you translate it across from pounds.
Looking at the earnings outlook though, does that show any signs of positivity?
Sure. So I think in pounds they'll probably be up somewhere in the order of 10% for the full year this year. This half year number, you saw quite a bit of currency weakness from a Rand perspective dragging down on their returns, and they were actually up 20% in Rand terms in South Africa and the UK, but obviously the Rand pound weakened. But we're looking for more or less 10% growth for the full year, and I think provided a lot of those losses fall out of the base and certain one-offs fall out of the base, you can look to possibly 20% growth in the coming year.
Where are we expecting this growth to come from, though? Do banks need to be more innovative and do something different, it seems?
A lot of the growth, and on that point, Investec are exceptionally good at certain things. They're very good private bankers. They're very good corporate financiers, and when they lend, they typically take equity stakes in things, and they make a better return and are much more entrepreneurial than the other big four banks. They're very good at asset management. They built an incredible asset management business over the course of the last 20 years, and they're very good at wealth management. What they've done, and the mistakes they've made in the past, is going into America, they pulled back. They went into Australia, they pulled back. They went into Israel, they pulled back and lost money along the way on those. In the UK, they've had a very successful business doing the things that they're good at. They then got into that kind of subprime space, which they're not good at and have got out of. So what you're left with now is an Investec, which is centered around the skills and the things that they've always created value with. They've got rid of the stuff that is peripheral and is not their skill and is not their core competence. And more of the asset base is moving into that, and the returns on that are fantastic. So, the business itself will grow because they're good at what they do. They've got good people, and that will take the earnings higher and the ROE higher and the earnings per share higher over the course of the next few years.
What about its comparison to South African peers? We're talking about the likes of the First Rank Group, Standard Bank, Nedbank. How does it fare?
Sure. So from a valuation point of view, you can see the table on the screen. So I think what just looking at the numbers there, this is our valuation. So we talk about the Investec South African part of the specialist bank, generating an RE of close on 18% there. And our valuation is a price to book multiple of just north of 1.5 times for that part of the business. Now, what this represents here is really a spectrum of where the various banks trade relative to the returns that they generate. Because obviously, depending on what type of return on equity you get, you will attract a certain price to book multiple. And that should be a linear relationship over time. And you can see there that along that line, it actually looks slightly conservative relative to where it should be trading on the basis of peer group valuations. I think FirstRand is probably the darling bank of the South African market, certainly. Priced as if its return on equity of 25% is sustainable. We think there might be a little bit of downside in the long run from that point of view.
I think another way to look at it quite simply is that if you compare it to the big South African banks, they're largely banks and they make banking profits. And those are trading at between 10 and 13p multiples. Investec has got the bank portion, but it's also got a asset management and wealth management business, which is a much higher multiple business. So in good times, if they're performing similarly, Investec should have a PE multiple probably 2 or 3 times higher than comparing it with just the pure banks who are having to use shareholders' money to lend it out to make money. In an asset management business, you don't have to have any assets. People give you your money and you earn a fee off it.
And wealth businesses are tough to build. I mean, if you look at their wealth and investment business, probably 2/3 of the profits will come out of the UK. If you look at their peer group in the UK, you're talking about businesses that trade at PE multiples in many instances of north of 20 times.
And let's maybe bring that up on screen, because it is a different picture when we compare to its peers in the UK, the likes of HSBC as well as Standard Chartered. Is it a better valuation on that side if you get exposure to Investec on that market?
So again, from a banking point of view, I think we've separated the two issues. We're saying the wealth businesses must attract a certain valuation and the banks a certain valuation. And from our perspective there, we've applied about 1.7 or 1.8 times book to the UK bank. That does assume that the current return on equity is sustained. We think it looks quite high, but we think the type of niches that they're operating in from a continuing perspective in the UK allow them to earn better returns. And when you look at the other banks down below, Lloyds Banking Group, HSBC, lower price to book multiples that they trade at, but much lower return on equity. But again, this does rely on the fact that the legacy book will run off and that the current returns they're generating inside the core bank will be sustainable.
Almost sounds like it's a UK story, but that brings us to the all-important question: what to do with this particular stock? Buy, hold, or sell?
At Anchor Capital, we've owned it and been buying it for the last 6 to 12 months, and I think we should continue doing so.
Continue doing so. I'm sure you agree with that, Sean.
Sure. I think there's enough valuation headway left in the tank. I mean, the easy money's been made. We were buyers at kind of the low 70s. It's now north of 100, and it's being priced as if not quite the returns that we expect to see coming through are sustainable, but it's getting there. So I think there's still upside, and we would remain buyers, but to say that there's 30% upside, I think might be a stretch.
That's a buy for Investec. And just like that, that's where we leave it for today. But do catch us again next time where we talk more stocks.